Good morning, Professor Deepak Nayak sir. My name is Ragini. I am delighted to be here today to present the topic of revenue recognition. Now, I would like to present my topic, introduction. Introduction of recognition. Revenue recognition is an accounting principle under generally accepted accounting principle. GAAP, revenue, is the gross influence of cash, receivable, or other consideration arising in the activities of an enterprise. Recognition is a process of recording of an item in a financial statement. Principles. Revenue are recognized when they are earned, realized, and realizable. Types of revenue recognition. Transaction. Here are the four types of revenue recognition. First one is sales of product. Second one is rendering service. Third is permitting use of an asset. Fourth one is sales of assets other than inventory. Revenue measurement. There are the three revenue measurement. How we can measure the our revenue. Consideration in the form of cash, consideration in the form of other than cash, uh, and barter transaction. Generation of sales revenue. Basically, these charts are generation of sale. These chart are shows the generation of sales revenue. I'm going to explain you. These are the generation of sales revenue. Uh, and next one, the same generation of service revenue. In this, franchisee, admission fees, advertising, insurance, commissions, entrance, and membership fees. Capital and revenue items. To determine which item which is financial statement, revenue minus profit and loss, capital item minus balance sheet. Next one is classification of expenditure. It is also important to classify the expenditure. First, capital expenditure, revenue expenditure, de- deferred revenue expenditure, capital expenditure. Uh, I'm, I'll explain the line-wise expenditure of these three expenditure. First one is capital expenditure. Purchase, receipt or erection of fixed assets. Improvements in efficient of fixed assets, obtaining necessary permission to carry on business, legal expenses, revenue expenditure is an expenditure incurred on fixed assets in connection with their maintenance, which are purchase of raw materials and goods, maintaining of fixed asset, depreciation on fixed asset, day to day business activity. Deferred revenue expenditure. Deferred revenue expenditure are expenditure partly or wholly paid in advance. Abnormal losses, development expenditure, production cost. Conclusion. Conclusion. The principle of recognition is an important for financial reporting because it allowed of consistent and transparent reporting on companies report performance. By recognizing revenue in a timely and appropriate manner, company can provide investor and other stakeholder with an accurate pictures on their financial health of and prosperity. Additionally, adhering to proper revenue recognition principle help to prevent misleading and fraudulent financial report. Thank you, Deepak sir, to giving me this opportunity to present on this topic. Thank you.